What's up, guys? So at this point, I've been involved with a fair number of VCs throughout my time in startups, and I thought I would tell you everything that I know about VCs, working with them, and whether you should. So my journey with VCs started 9 or 10 years ago when I was interviewing for a company, Outright.com. This company was the first company that I was going to start my career with in Silicon Valley after leaving college and living back home for like 3-6 months, something like that, applying to every tech company I could possibly think of. Now, because I was a very early engineer, we were like a 20-person company at the time, they were still having people interview with the VC that sat on the board. This VC worked at the Sequoia firm at the time, and that was quite the experience. I'd never been introduced to this VC world or really even the startup world to that point in time. So I go down to Sand Hill Road. Of course, I take my mom with me because what good kid doesn't take their mom with them when they're moving away from home? That's ridiculous. So I go to Sand Hill Road, I walk into the Sequoia offices, which are insane. It's like this super nice building with like the super nice lobby area and a super nice front desk attendant asks if you want a drink. And they have every drink known to man, and it's insane. You walk back into the office, it's all glass, it's beautiful, it's amazing, it's amazing. VCs have some money, and at the same time, they have a brand that they need to maintain. Sequoia's brand is as one of the high-class VC firms, so they need to maintain that as much as they can. Now, I got through the conversation with him. It was a very interesting conversation. We discussed some of the side projects I was working on, this and that, and lo and behold, the recommendation from him was to not hire me, which I found out years later. That was cool. Neat. And why didn't they want to hire me? Well, honestly, it comes down to my quote-unquote pedigree. I didn't go to one of those Ivy League schools. I don't have a computer science degree, and I'm asking for an engineering job. And, well, I just didn't fit the bill and the mold. And you'll find this a lot with a lot of VC firms. There's definitely quite an elitist sort of world there. Now, that doesn't apply to all VCs, and some of that, like I said, is branding. Now, they've hired some of the best and brightest people in the business world to make investments. And honestly, that's some of the stuff that's required. And if you look at some of the best and brightest in business analysis, it does come from these Ivy League schools. So that makes sense. So now you have the context of where my story with VCs began. Now, I've been interacting sort of third party with VCs for many, many years. They were they were the backer in Outright. We had multiple VC firms involved there, and they started driving the direction there for a period of time, and that was an interesting experience as well. So I've gotten to see both sides of the VC coin in terms of involvement with the companies. So at Outright, they had a very heavy influence there because, well, we were a much more capitally strapped business. Now at Greenbits, we didn't even have to involve VCs until later in the process, and part of the reason we involved VCs is to get the connections and the experience of the VCs in general. And that's one of the big benefits to bringing in a great VC. A lot of times, yes, your business is going to need the money, but you can get money from a lot of places. It's kind of crazy how many places you can get money from. But you bring VCs in a lot of times for access to their connections, their experience in building businesses, and oftentimes they'll have some sort of portfolio business, whether it's currently active, less likely because, conflict of interest, or previously successful, that is relevant to or similar to your existing business. And they have a lot of insight and a lot of learnings from people that have come before you. And that's one of the big upsides to VCs. Now, you've learned a lot about what's it like to work with VCs. Now, how do VCs even operate? So VCs are interesting because they are very, very similar to syndicates that you'd find on something like AngelList or something like that. They're just a longer term thing. Actually, think rolling funds at AngelList. And if you haven't checked those out, I'll put a link in the description to learn a little bit more. They're very interesting. I haven't dug deep into them yet. If you're interested in that, let me know in the comments and I'll do a video on it soon. But what VCs do is basically every 10 years or so, they go and raise funds. They raise these funds from large institutions that have a lot of cash lying around that they need to make returns for their investors in. These institutions are things like Stanford, Harvard, Yale, hospitals, boards of education. Think those really big, sort of boring institutions that have a lot of capital that they need to grow rather quickly. They raise funds from them every 10 years and put that into a big, big pot. Now, across some of the top 4 VC firms, they have over $32 billion in assets under management right now. Those firms are things like Tiger Global, Sequoia, Kleiner Perkins, and Andreessen Horowitz, or A16Z, if you're tired of saying the words, because, well, Andreessen Horowitz is quite the mouthful, so thank you for going to A16Z. And if you've been involved in tech or read about any sort of tech, Tiger Global actually invested in Greenbits early on. They also invested in Dutchie during their latest raise, as well as I believe their previous raise, but don't quote me on that one. They were also involved in the recent BlockFi raise. So they're all over the place. These VC firms are backing many, many companies. And because they raise funds every 10 years, they have a timeline to their investments. Oftentimes they're looking for some sort of valuation shift or preferably a liquidity event in 5 to 8 years of the time of investment. Now, why is this interesting? Well, if you're investing alongside VC firms, maybe that's in an angel list syndicate or something like that, or maybe you're private investing yourself because you have too much money sitting around, or you are an employee or a founder of one of these companies. It's good to know the timeline of the investors, because as you get closer to that 5 to 8 year time frame, you're gonna be seeing slightly different activities coming from these VCs, where they're gonna be pushing more and more for numbers that are gonna be good for your next raise, or pushing more and more for a liquidity event, whether that be an IPO, which is, I would say, less likely, or an acquisition if they're having to push for it. If they're having to push for it, you're probably not doing IPO level, because why didn't you just IPO already? Now, something that I found really interesting about VCs a long time ago is that less than 1% of most of their funds are actually from themselves. They raise these funds, but the VCs themselves don't actually put a whole lot of their own capital in. So how do VCs make money? Well, they charge 2 different things. One is a straight management fee. Oftentimes that management fee is roughly 2% of the total assets under management. So you can imagine across these 4, $32 billion in assets under management, what sort of management fees they're bringing in. But that's just to keep the lights on. That pays the salaries, which are high. It pays the office rent, which are also high. And all of the other overhead of operating a VC. So where do they make their real profits? They make their real profits in something called carry. It's a carry fee. Typically, this is a 20% carry fee. You've heard me talk about this previously in the Angel List Syndicates video that I did here. Now, a carry is basically something that the people investing in the fund are going to pay to the people running the fund as a thank you, a tip to making me money. So it's basically 20% of all profits are going back to the VC firm. So they're trying to make big winners. They're incentivized to win, which is the best sort of business model to have, right? If they were only making money from management fees, why even bother really? Don't try. Just invest in everything, get all the money. So they're incentivized to win. And oftentimes, especially some of these earlier stage VCs, something like Founders Fund, for example, they're looking for a 10 to 50x return on their investment over the next 5 to 7 years. And on average, they're looking for a 40 to 50% IRR over the length of the fund, which is awesome and amazing and very interesting from an angel investing perspective, because as you get further and further back to the earlier stage, like angel investing, seed, pre-seed, all of those things, the returns become a lot higher. Yes, the risk becomes a lot higher, but you can realistically expect a 40 to 50% IRR on your investments if done properly. Now that's basically everything I know about VCs. If you have more questions about VCs, I probably have more in my head that I just couldn't think of what I know. Drop them in the comments. I'd be happy to make a video or discuss in the comments. If there's someone that you know that's working with a VC now or considering it, send them this video, see if it helps. And as always, like, subscribe, and I'll see you guys next time. Peace.